Let's stick with this conversation about the markets and bring in Chris Brightman. He is CIO at Research Affiliates. Chris, good to see you. I'm going to ask if this rotation out of growth and into value has sort of peaked, because we've been seeing some more interest in those high growth tech stocks. What are you doing personally?
Well, what we observe is that we've entered a sort of a sweet spot for value investing. What I mean by that is that the difference in valuation between growth stocks and value stocks is still near all-time highs. Of course, value stocks always trade at a substantial discount to growth stocks, but the amount of that discount varies enormously through time. And we had reached the point several months ago, maybe even 6 months ago, where we were literally at the all-time high discount for value stocks versus growth stocks. And while we've had a tremendous period of outperformance for value over the past 6 months, we remain near all-time highs in how cheaply value stocks are priced to growth stocks. But now we have positive momentum. So the prospects for a continued rotation look pretty darn good. That said, forecasting stock prices over periods of days, months, and weeks is a fool's errand.
I know, despite how much we try, we always like you guys to pull out your crystal ball with some degrees of success. So, Chris, I do want to ask you about some of the inflationary moves that we've seen lately. Yesterday, those CPI numbers that came out, obviously inflation running pretty hot. I would have expected tech to take a leg lower, and I actually would have expected just the markets to take a leg lower yesterday. We did not see that. Even right now, the Dow is the only index in the red. So how are you reading this inflation narrative moving forward? Are the risks overblown? Is it clear to you that some of these moves are transitory?
Well, it's crystal clear that the market is pricing them to be transitory. I think we have to be humble about our ability to forecast really what's going to happen, because we've never seen this before. We never intentionally closed down huge portions of the global economy, simultaneously providing enormous quantities of stimulus. Literally, the Treasury wire transferring money into people's bank accounts on a regular basis and then go through the reopening. It's absolutely the case that we would expect a huge spike in inflation, and we just saw that. Year over year, 5%. If you go month over month, it's 7.5%. That was certainly more than forecast, but everybody understood that any point estimate of the peak of inflation was just a guess, and that everybody was anticipating and was prepared for, transitory high inflation numbers. So, the truth is we just don't know. What I would say, though, is you don't need to be worried about price spikes from bottlenecks with the reopening of the economy. That's normal. That's no concern. If we start to see, however, a permanent increase in government transfer payments that isn't paired with increases in tax receipts necessary to fund those transfers, that's the sort of thing that ought to cause one to be concerned. Right now, the Fed has told us they're not doing anything until 2023. And so all eyes are on Congress. And with Joe Manchin holding the purse strings, I think markets are very sanguine about future inflation prospects.
Well, what do you see as sort of the biggest upside risk for the market going forward? Would it be higher taxes, legislation from Congress? Or we know that the G7 leaders are talking about a higher corporate tax rate across the board, 15%. Would that be the thing that would trip us up?
Oh, I think we need more tax revenue. So the discussion of a global minimum tax, discussions of tax simplification and increased tax enforcement if any of that moved from idle discussion to actual policy and implementation, that would be all to the good.
And before we let you go, real quick, do you see any opportunities outside of U.S. equities right now on the international stage? And if so, where?
Yes, I mean, look, we're very home biased in the U.S. We focus on everything going on in the U.S. and don't pay a lot of attention to the rest of the world. But the rest of the world matters a lot, and it's just beginning. This reopening of the global economy and the resulting reflation trade is very early on. So I think there's a lot of room to run for small outperforming large, value outperforming growth, international outperforming domestic equities, particularly EM currencies outperforming developed. I think we're going to see for the next year or two, those are the trades to have on. Those are the themes. Those are the sort of structural factors that are going to be driving prices.
All right, Chris Brightman, CIO at Research Affiliates. Thanks for being with us today.